What I'm going to discuss today is mostly about the way that I actually trade and the reasons I trade that way. And when I talk about trading, when anybody talks about trading, they're talking about it from their perspective, but also with their own risk parameters. And I'm a bit of a wimp when it comes to trading, to be honest. But I am talking about the way, what I'm prepared to risk. So just bear that in mind. I will talk about risk as we go, but this is all about my risk parameters. And when you do this for yourself, think about your own risk parameters as well and how you apply this information. So as I said, we're going to look at staying on the right side of the market. We're going to be looking at how to use market depth and order execution information together. And also how to prioritize those two, because there's a lot of tools now that focus on market depth, and kind of the order execution side of order flow is probably a little bit more important than the depth. And as I go, we're going to talk mostly about long positions. Okay, so just presume that the opposite applies for shorts, and that'll save me saying everything twice. But first, as I said, let's spend some time discussing HFTs, high frequency trading, algorithmic trading and market making, because if you're going to stay on the right side of the market, then you have to stay off the wrong side. And of course, it helps to have some idea of who is on the other side of your trade. Okay, and to do this, we're going to look at both futures and equity markets for reasons that are going to make sense as we go. So I know you're all futures traders, but we're going to look at the equity markets as well. Because there's a lot of hype nowadays about HFTs. We hear people talking about tracking the algos or beating the algos, but that rarely comes with any explanation of who you're beating or what they're doing. So you might hear someone say, you see this white area on my screen, that's an algo. Okay, so which firm is it? What's the strategy being employed by that algorithm? What's their holding time? Where are they going to exit? And it's common to hear statements such as the algorithms are taking the market up to VWAP. Now, whilst the market may well go to VWAP, there is little evidence that it is specifically the work of a single or group of algorithms intentionally moving the market to these locations. And similarly, when traders get stopped out of a trade, many are now blaming that on algorithms, saying things like, oh, the algos took me out. So it's become fashionable to talk about the algos. And many people now presume that if something happened in the market, an algorithm must have actively made that happen. And it seems that this is now becoming common knowledge, yet at no point has anyone actually proven these statements to be true. So in fact, I've also never seen anyone really question these assumptions. So everybody's saying the algos, the algos, the algos, but nobody's saying, well, is that really right? So, and even though, they're not questioning it, but if we have to think about it, where's all this beat the algo information coming from? It's coming from people trying to sell us something. So when I hear this, first thing to mind is how realistic are these assumptions? And if you're like me, you probably want to validate major assumptions about the markets before you change the way you trade to accommodate them. And that's what we're going to do right now. Now, according to this quote here from the Wall Street Journal, the best days for high frequency trading are when the markets are going up and down with high volume. In other words, HFTs benefit from volatility. And that differs somewhat from the notion that HFTs cause volatility by actively pushing markets up and down. The article on the right discusses HFTs as firms that make markets. And making markets is a very, very different activity in terms of risk, timing trade, and market impact compared to actively moving markets. So let's wipe the slate clean in terms of what HFTs and algos are rumored to be doing, and let's look at what we know they do, why they do it, and how they benefit. Now, this information isn't coming from me. So this isn't a presentation of what I think goes on or what I'm guessing goes on. This comes from people in the industry, both people working at algorithmic trading firms and people that advise them. But any errors in here, we're going to have to blame me for that, not them. And the other thing is you can fact check what I'm telling you now. So once you've got this knowledge, you can go and fact check this stuff, and I would advise you to do so. Now, pretty much everybody in this room is a futures trader trading outright directional positions. So you buy to sell higher, sell to buy lower. And this is where a lot of the misunderstandings about HFT come from. People presume that HFTs must be trading the same way they trade. And a lot of new retail traders see this kind of directional trading as the sort of trading that everybody must be doing. And it's simply not true. But anyway, let's stick to futures markets because it's what we all know, and consider the following strategy where your losing trades cost you 20 cents and your winners get you $12.30. You've got a one tick target and a break-even stop loss. You trade 5 lots at a time and you do this 25,000 times a day. You've got little or no directional bias. All you care about is getting filled at the bid and then either scratching the trade at break even or getting filled at the offer for a one tick profit. Now, how many times would you need to be right to make good money? Well, if you were wrong 90% of the time, you would make about $130,000 a day. And this is typical of one type of strategy currently employed by the larger HFTs. The focus is on minimal to zero risk and a favorable risk-reward profile. Now, the top band of volume discount at the CME starts with an average of 135,000 contracts a day. Now, this is not for designated market makers. The designated market makers get this discounted rate at around 50,000 contracts a day, but we'll talk about those guys more later. Now, this level of volume, it's costing them 9 cents for clearing plus 1 cent to trade, or 20 cents per round turn. Now, I've actually heard lower figures than that quoted, but I couldn't find those on the website. So some of the people in the industry said, actually, it's lower than that, but I can't find that. Now, I think we can all agree that these discounts are there to encourage higher frequency traders, because if 135,000 contracts a day isn't frequent, I'm not sure what is. Now, this particular style of trading we're talking about is all about getting a good queue position, and that's also known as getting to the top of the book. And that means being at the front of the limit order queue, or very close to it, on the inside bid or inside offer, and being the first person to get a fill when a market order comes in. And if you're the first in line on the bid side, and you have liquidity behind you, you get the first fill, and then you can take a one tick profit at the offer side, or you can scratch a trade. And with this style of trading, you have an exceptional risk reward ratio. You don't need a high win rate. You don't need to trade large just frequently. You don't need to move the market around, and you don't need to risk a lot of money per trade. Now, of course, to make this work, you actually need to get filled on the bid and get out of the way before the bid breaks. So you need to sit on a lot of bids. You need to decide when it's best to bid a price, and you need to cancel those bids before you get a fill if you feel the trade looks risky now. If the market's in such a state where you think, I actually don't want to be on the inside bid. Okay, that's important. Please remember that part. Now, you also need to scratch trades if you get filled and you think the bid will break and price is going to move against you. So with this strategy, once you're in a trade, you have to guard yourself against something called sweep risk. And that's the risk that the bid you entered on will be swept away by sell orders and that price will move one tick against you, leaving you unable to scratch a trade for that 20 cents loss. So if these guys think there's a chance of a sweep, they're going to exit. So how would they predict a sweep? Well, probably in a lot of the ways that we would expect. Some things like, some of the components we use ourselves, such as looking in the queue behind you to make sure there's plenty of liquidity there, maybe looking in a correlated market, that kind of thing. But what seems to annoy many people is that when HFTs use an information advantage to guard against sweep risk, and HFTs paying for order flow seems to be pretty close to the top of the list in terms of what people consider an unfair advantage. And this is common practice with stocks on NASDAQ. And as you may know, stock traders can target a specific exchange when trading stocks. But most traders are just going to put in a market or a limit order, which they presume will go to the best exchange at that point in time. And these non-directed orders often then get sold to the highest bidder, who gets to route the order. And at the same time they get to route the order, they have a very short-term information advantage because they get to know about these orders before they hit any exchange. Now, here we can see a report from TD Ameritrade that shows Citadel and Knight Capital as number 2 and 3 buyers of TD Ameritrade order flow. Okay, they're actually number 1 and 2 in terms of market orders. Now, these guys are 2 of the largest players in the HFT space. So 48% of market orders placed on TD Ameritrade get sold to these 2 firms. Now, we can see they're not very bothered about buying limit orders. After all, with this kind of strategy, they want to know about orders that will consume liquidity, not add to it. And the term toxic order flow is a term that refers to order flow that threatens to sweep the bid that the HFT is filled at. And I have no doubt whatsoever that this term, toxic order flow, will become a widely used buzzword in the retail trading industry, and that before long we'll see toxic order flow indicators. But the reality is, all that toxic in order flow represents is that the risk that the market will move one tick in the very short term. It does not mean the market will continue afterwards. So anyway, the upshot is that order flow can be purchased, which means that firms like Citadel, Knight, Jump, Getco, Virtue, etc. may get orders from TD Ameritrade before anyone else, and they can scratch their bids or just cancel their bids or scratch their trade if they feel the order flow is toxic and represent sweep risk. Now, this isn't really front running the market, okay? But it's not a million miles away either, which is why that kind of activity is unpopular. Now, how big are these HFT companies? And this is important because, we hear things like 80% of all trading is algorithmic, okay? Wow, that's a big number, but we don't hear how evenly distributed this is. Okay, so most of the HFT firms are private companies, and they don't have to publish their results in the US, but there's still plenty of information out there. Now, in 2012, the model broke down at Knight Capital due to what they said was a software glitch. Now, this is a firm that in the first half of 2012 was responsible for 11% of all US equity trading, that is a massive amount, massive percentage. And then one day they had a glitch in their software and they lost $172,000 a second for 45 minutes. And this was in 2012 when $172,000 a second was actually a lot of money. Now, considering the overall transaction size per trade is relatively small, this is a massive number of trades being executed. And Knight are actually one of the biggest players, although they weren't so big right after this happened, because this 440 million was very close to their annual profits, I believe. Now, if you look at this article, one of the things, if you can see at the bottom, that's interesting, they say it was down to a bug in their market making software. Not market moving, not directional trading software, but market making software. And as you research this yourself, you're going to see the same thing over and over and over again. It's not about trading directionally at all. Now, there's little benefit in tracking this sort of activity, even if you could. So these small trades aren't moving the market. They're in and out over and over again all day, just chipping away at the market and taking small, relatively risk-free profits over and over again. And with these companies playing around the spread, we should at least be able to admit that when an HFT is bidding the market, they're providing liquidity. And once they're filled at the bid, they're going to offer the market and they'll provide liquidity there too. So we as traders benefit from narrower spreads. The thing is though, unlike designated market makers, HFTs have no obligation to trade. So there is a tendency for them to all disappear at the same once when conditions don't look right for them. Now, we've mentioned market making a number of times. So what exactly is that? Because lots of people talk about market making and, it's like some mystique about what it is. You can make a market without being a market maker or without being a designated market maker. And all that means is putting limit orders into a market is effectively making the market. So HFT's top of the book trading is market making, but these firms are not necessarily designated market makers. So what's the difference between HFT market making and a designated market maker? Well, designated market makers take risk. They have to sit on both the buy side and the sell side of the order book. Now, they get fee reductions and credits and other benefits for taking on this role, but they have to take on a lot of risk. And to highlight the risk of being a designated market maker, we can see in the crash of 87, many market makers were effectively bankrupt in one day because they'd been obliged to trade both sides through the crash. So we can think about HFTs as fair weather market makers. They've got less incentive to trade from the exchange, but they can just stop anytime they like. And this is one of the reasons we get exaggerated swings in liquidity and volatility in today's market. There's a lot of market making going on that can just stop abruptly if the conditions don't look good. So these HFT guys, they can just switch off. And it used to be, going back 1 or 2 years, it used to be as soon as the VIX got over 24, all the liquidity would disappear from the market. It was almost as if that was a watermark. And you've got to wonder how long the designated market maker is actually going to be around, given this kind of imbalance between what the market makers and the HFT market makers can do. So that's market making. Another form of algorithmic trading is arbitrage. Now, the top of the book and market making strategies are non-directional. They don't involve having an opinion on the market really beyond the next few ticks. And similarly, arbitrage, which also represents a huge proportion of all trading, is again non-directional. And like HFT strategies, arbitrage is theoretically very low risk. And it's traditionally the process of trying to make money from some form of price discrepancy on two or more markets. Now with HFT, it is actually making money from more than just price discrepancy now, sometimes time discrepancy. Now, one of the ones that is quite popular that most people know about is index arbitrage, and that's trading an index derivative such as the S&P 500 futures against a basket of stocks. So when the futures and the stocks diverge too much, like if the futures go up and the stocks go down, then an arbitrage opportunity occurs. And in that case, they would sell the futures and buy the stocks. Now, the risk to the trader is that the instruments continue to move apart or to diverge and that they end up with two losing positions, but this is really rare. Now, arbitrage keeps related markets in line. In fact, as competition increases for arbitrage opportunities, the potential reward for arbitrage trades gets smaller and smaller as people, or algorithms, are prepared to step in front of each other and trade a smaller and smaller price discrepancy. Now, with so many arbitrage opportunities and market making opportunities, we might presume that algorithmic trading is evenly distributed across all markets, but this is not the case. Now, rebate trading is a form of arbitrage, and with that, traders get paid a small fee if they put a limit order into the market and it gets filled. Then all they need to do, once they've got filled, they get their fee. They've just got to try and figure out how to get out of that position so they can keep the fee or maybe make a one-tick gain. Now in 2010, if you were around then and if you ever looked at Citigroup, it was a really strange thing. We had a 300 million shares would trade on a good day. The daily range was about 5 or 6 cents. And the trading in Citigroup at that point represented 7% of all US stock trading. Now Citigroup was under $5 a share, and what was happening is HFTs were attacking Citigroup. It was low price, low volatility, low margin. It attracted all these HFTs, and all that happened on Citigroup stock is it just spun around in this very, very tiny range all day, trading millions and millions of shares just to get the rebate. And of course, this activity was not at all appreciated by Citigroup management because it was effectively thickening up the stock, the liquidity, to the point where price movement was impossible. And that activity only stopped when Citigroup did a reverse stock split to increase the price of their stock. And that in turn increased the margin requirements to trade the rebate. So all these millions and millions of shares, it now became a lot more expensive to do that. And that stock split that they did here was done specifically to shake off those HFTs. So again, 7% of all stock trading, just one single stock, okay? Now, if Citigroup got upset about HFTs interfering with their price, then latency arbitrage manages to upset a much, much larger group of people. And this is what the book Flash Boys is all about. It involves a really big infrastructure investment to be the fastest point between two exchanges where the same instrument trades. And that's usually applied to NASDAQ because NASDAQ is a network of exchanges and the same stock can be traded on any of them. So the goal again is to make 1 cent or less in price discrepancy between the price of a stock on two exchanges. And this is another HFT activity that people really aren't comfortable with this because they feel it's very close to front running. And it certainly is risk-free on a per trade basis and is not directional trading. Now there's many other forms of arbitrage and there's plenty of information online about it, but the key is it's non-directional. It doesn't involve benefiting from the move in a market in one direction or needing to push a market around. And there's lots of other types of algorithmic trading because even your platform's automated exit order placement is an algorithm. Even if it's just a little helper program to help you manage your order, that is an algorithm. Now, if most algorithmic trading is a form of arbitrage or market making, it's not particularly harmful or predatory, but that doesn't mean that predatory trading doesn't exist. Now, predatory trading is by definition riskier than the kind of HFT strategies we've talked about, because HFTs try to be low to zero risk, but predatory trading is going against other weaker traders and it's inherently risky. Now, predatory plays are a bit like bluffing in poker. In the example over here, we can see spoof or fake orders on the offer side, and we can see an iceberg on the bid side to absorb all the selling. Now, by definition, a predatory play like this has to be given time to work out. So if you're going to spoof people, or if you're going to fake people into selling a market and then get stuck, you've got to put those fake offers up for a reasonable amount of time. You actually need people to see this, trade against it, get stuck, so you can then force them out of position. So if you were just going to put up these fake orders for a microsecond, nobody would see it and fall for it. Okay, so it takes time. Now, because it takes time, you can't do it as often each day. Now, predatory plays are risky because they involve building a large position and betting against other traders. So any predatory trader could, in theory, be taken out by another larger predator. Now, not only is there a risk of losses, but also there's a risk of a fine or a ban. Although, to be honest, the people who get fined and banned for this always seem to be fairly small. And in this case, a guy called Nitin Gupta was flipping, and basically that's the art of making the market look weak, encouraging people to sell, and then buying the market to drive the market up and stop them out. So how do you avoid being pushed around by a predatory trader? Well, common sense really. Predatory traders are opportunists. They're not daredevils, so they can't stop a one-way move. When a market's heavily directional, they're not going to be in a position to just step in front of that market and push it around. Now, if a market's range-bound or at a technical reversal level, then absolutely that area is a good spot for short-term manipulation. Now, the art of predatory trading is not to push the market around a huge amount, but rather to let other traders do all the work. And that brings us to an extremely important point when considering the validity of any claim that an algorithm is pushing the market around. And that is, how do they get out? Because if you push the market up 5 ticks by buying 2,000 contracts, how can you exit at a profit? If you just sell those 2,000 contracts, the market's going to go back down. It's not like you can put a pin in the market and keep it there while you get out of your position. And that's the key to predatory trading. You need other traders to be there for you to exit at a profit. And the best way for you to do that is to force other traders out of position. So you entice traders to go short while you go long. You give the market a nudge, and when those guys buy to cover, you sell to exit your long position. So your stop orders are where the predators take profits. Now, there is a push to nudge traders out of position, but this is not moving the market tens or hundreds of ticks. It's just enticing other traders into bad trades, so their stops do the most of the moving. So on a market like the S&P 500, you'd be looking for a predatory play to generate something like a 5 or 6 tick move. Now, given the market neutral aspect of most of this HFT activity, it's really hard to see how HFT is going to impact the average mouse trader whose reaction times are measured in seconds and holding times measured in minutes and hours. Now, it is scary when we hear things like 80% of all trading is algorithmic, but that doesn't mean that 80% in all markets. Citigroup was 100% HFT effectively, and that stock alone represented 7% of all US stock trading. Now, of course, when people use statistics to prove a point, they're going to make them sound as sensational as possible. But even the retail trader, for example, using a NinjaTrader ATM strategy to exit their trades, that trader is 50% algorithmic because the ATM orders are algorithmic orders. You didn't place them, the computer placed them. Now, we've always had traders with different holding times, and that's never really been an issue before in the industry. So, we have long-term investors, we have swing traders, position day traders, scalpers and HFTs, all playing the same markets at different timescales, and in a way, each providing liquidity to the traders playing the timescale above. Now, scalpers play the market on a level down from position day traders, the position day traders being the guys going for the 10 pointers. But they don't necessarily interfere with the position day traders' trades. I mean, when was the last time you missed your 20-tick target on a trade and you thought, man, them scalpers took me out? Never. In fact, when a scalper's sitting on the bid waiting for an exit, he might have just tightened the spread for a position day trader waiting to get into the market. Still, there's a lot of hype in the retail trading industry right now about the algos, and the sales pitch seems to be that Algorithms are responsible for large moves in the markets. In other words, that there are market moving algorithms that actually push the market around and have targets at tens or hundreds of ticks away. That these algorithms are taking you out of your trades, and that you need special software or training to beat these algorithms, or you need to write your own algorithms because somehow these guys are the enemy. Now, given what we know about arbitrage, we know that market moving algos would need to not only move a single futures market up, but it would actually have to pull up all the related markets too. So pushing up the price of an index future would bring in index arbitrage traders because the futures would go up, the stocks wouldn't, so they would sell the futures and buy the stocks. So whenever you get into that mindset of the algos are doing this, have a think about where their exit would be. How many contracts they'd be holding. If they're pushing the market up 10 points, 20, 30, 40,000 contracts to do that, how are they going to get out of that trade? So predatory traders, they're playing small moves, exit into stops. Unwinding a massive position with nothing to exit into would just cause an equal move in the opposite direction. And the fact is, HFTs, these big firms, they don't need to get into risky positions because they can get into lots and lots of much smaller, low-risk positions through the day. Now, the quote here is from a professional trader that would rather remain nameless, but I think this puts it, this state of affairs better than I ever could. There's a lot of fear-mongering. Now, if you look at the anti-HFT sites like Nanex and to an extent sites like Zero Hedge, we hear that spoofing is at an all-time high. Now, they base that purely on the amount of orders being cancelled, which has risen dramatically. Now, but spoofing is the art of placing orders you didn't intend to fill, usually to dupe other traders into front-running your order. Now, a top-of-the-book HFT strategy will, of course, cancel orders if they think the trade is now too risky. That is not manipulation, and it is not spoofing. Every trader cancels orders if they feel the trade is more risky. Now, of course, it happens more frequently with HFTs because they trade more frequently. So we can now look at the anti-HFT articles in a new light. Was that flash crash caused by HFTs manipulating the market down, or did they just all get out of the way? So many traders have become fearful of these market moving algos. They get so wrapped up in looking for ways to beat them, they don't stop to think about whether they actually exist. And one educator wrote an article recently saying an algorithm spoofed the market down 10 points. And the implication there is that it's possible to make a market move without trading a single contract, that spoofing the order book is enough. Now, that's sure, if traders were dumb enough to consistently jump in front of high bids or high offers, that would work, but the fact is they're not. Another article I read claimed that just before the S&P 500 reversed, a series of 50 one-lot orders would print on the time and sales. And the author's theory was that these 50 orders were a signal to other algorithms to start trading in the opposite direction. So it's like an algorithmic Morse code. So not only do we have algorithms moving the market, they're actually talking to each other through the tape. Now, the author actually seemed like a decent guy, but this does highlight the tendency to see a pattern and jump to a conclusion. It's like believing that Bigfoot exists and then looking for ways to prove it. And much of this fear-mongering exists purely to part you from your money for software or education to solve a problem you really don't have. Now, make no mistake, predatory traders do exist. They always have done. Your stops are going to get run. They always have done. But the main goal of HFTs is to make relatively risk-free money frequently and not to move or predict the markets. Now, markets have always moved around. They did before algorithmic trading ever existed. And the existence of volatility alone is not proof of algorithms moving the market. In fact, volatility increases, mini flash crashes are as likely to be caused by HFTs getting out of the way as them pushing the market. So staying on the right side of the market does not require you to trade up against robots or make decisions in nanoseconds. Day traders are simply trading a level above HFTs and a level below swing traders and institutions. So you can certainly ride on the momentum generated by longer term traders, but there is no upside in trying to beat somebody that is trading for one tick. Because with an HFT, by the time you know they're there, they are most likely already gone. So what does it mean to stay on the right side of the market? Well, my personal focus for getting an entry and staying with a trade is on understanding short-term speculation, where the pain points are, and where short-term speculators might come into the market. Because much of the time, short-term moves are driven by short-term speculation. In other words, there's often not a lot of long-term institutional trading moving the markets. Then there are times when volume spikes, often after news, where we can say that exceptional volume is driving the market one way, and that is most likely institutional volume. So these higher volume, heavily directional periods are theoretically easier to trade, although you sometimes have to sacrifice getting a good entry price by just jumping on board or the move passes you by. Pullback traders like me suffer on these days because there are just no pullbacks. So in other words, it's the time frames above you that set the tone of the market by their participation or equally by their absence. And the average volume speculation driven periods or driven days, they're going to have usually 3 or 4 major intraday swings or short-term trends. And on these days, the right side of the market changes many times as speculators take profits, get stuck, or see profit more likely in the other direction. Now, getting a handle on the flow of orders helps us to understand where speculators are trading right now and where they're getting stuck. And that brings us onto the tools. But I'm going to give you a word of caution. With the advent of these kind of pretty looking order book heat map tools, there is going to be a tendency for you to focus on what is the most visually stimulating. And we shouldn't lose sight of what is important and what activity these charts actually represent. So for a start, we need to carefully consider how much weight we give to the market depth information, which after all is much prettier, and the actual order executions and what they might say about traders' positions. Because the depth, the market depth, it's intent, or at best, what they might do. And the order executions tell us where people actually traded and what the impact was. And we should think about this in another way too. Historical versus current information. Because this isn't just about which view is best for reading order flow, it's about which view is best at what time. Now the tools you're seeing here are part of the Jigsaw Trading toolset. And what we can see here, we can see market depth, bids and offers in 2 places. First of all, on the depth and sales, we've got this inner blue column, inner red background column, and that's showing us the bids and offers. And that information is current right here, right now. Then we can see the Auction Vista chart, and we have offers above and bids below. And the lighter colors indicate more depth in that area. So everything to the left of this vertical line is historical, and to the right is here and now. We can also see order executions on the depth and sales over here with the current trades columns, and this is showing sellers that sold to bidders in red numbers here, right in the middle, and buyers that bought from offers in the blue numbers here. And this is just showing activity this time round. It's not cumulative, and it will be reset when you come back to a price. Now on the Auction Vista, we can see order executions in two ways. So between the yellow lines, we have what we call a trade thermometer. And you can see over here on the left, we have this long run of red. And that means that during this time, the aggressor executions, the market orders submitted, were mostly sell orders. But that overall, the volume really wasn't significant. Then you have the large trade circles. They show when exceptional volume trading occurs, but not at any specific time splice or specific interval, but over time at a price. And the size of the circle represents the volume of trade, and the colouring represents the balance of trade. So more blue represents more buy market orders, and more red represents more sell market orders. And we can see these circles develop in real time and move to the left as they build. As soon as that exceptional size is detected, the circle will start building, and as long as we're trading there, it'll just get bigger and bigger and show us a balance of trade. Now many traders will be more attracted to the charts and feel put off because of the numbers on the depth and sales. Well, the depth and sales is all about current information, but surprisingly, it's not really all about the numbers. It's about the pace of the market, the way it speeds up and down, prices that are sticky and prices we can't hold for a second. And of course, it's also about how much volume it takes to get through prices, but mostly it's about movement. And we still recommend people new to order flow start off with drills on the depth and sales here so they get like a raw, unfiltered, organic feel for the order flow. And people benefit from seeing common order flow events playing out here first, so that when they come over and look at the chart, they've got a really good understanding what this visual representation is really telling them. Now I still use the depth and sales for right here, right now, refine and entry analysis, but this history has given me a valuable overview. I'm going to walk you through a few slides now so you can get a feel for what the history brings to the table and how you could incorporate it. Now first of all, we know that some market depth is real and some is fake. Sometimes the market depth reacts to price approaching it, sometimes price reacts to the market depth. So in this case, the market depth was real. So we'd actually been up to 30.61 on this day, down to 30.46, and this is retracement back up to 30.57. Now at this point, as the market's retracing back up, you're probably either looking for a fake breakout, head fake, double top, or to get short on a failed retracement. So for me, I'm thinking this market's already done its reversal. Now I'm looking for an entry. Now on the way up here, we can see exceptional depth above us, and at each price, we actually traded that depth, and the offers actually stayed firm as we traded through them. And we can tell that because it took exceptional volume to trade through exceptional depth, because we got the circles. Now trading wasn't balanced on the way up. If we look at the aggressor side, the market orders, they were predominantly buyers, and that is normal on the way up. In any move up, normally expecting an imbalance of around 1.5 to 2 times buyers to sellers with price progression. Okay, when you don't get the price progression, that's a heads up. So buyers were in the majority on the market order side. Sellers were quite happy to progressively absorb more and more of that buying as we moved up. Now, as we got to the top, the imbalance was actually much larger than 2 to 1 as we reached this turning point. And there's a noted lack of aggressive sellers. And there's a reason for that. There's no need for smart sellers to be selling at the market if they're going to be absorbing this buying. Okay, so the smart sellers are just saying, okay, we'll sell you some contracts, we'll sell you some contracts. They don't need to put sell orders, market orders in at this point. Now, as the market rolled over, we can see that moderately high offers followed the market down. And this is very typical of market maker activity, looking to pick off traders that take trades against the trend. So where do you actually enter a trade here? Well, first of all, you always have to have context. And in this case, we're in a pullback, in a move down. So that's good context. If you didn't have that context, you sit on your hands. Now, you could enter when you see these high offers, but what you'll find is if you just enter because of big offers, bids and offers, it's going to be very hit and miss, even if you are in a potentially new downtrend. And it's extremely rare for me to make a decision to enter a trade because of high bids or offers. It's useful information, it's just not enough on its own. So selling in front of large offers or buying in front of large bids is going to be a net losing strategy. Now, where I am more likely to enter is where the stuck buyers look to be getting stopped out. So we can see that the buyer absorption started really around 30.53 up to 30.57. And that means we have a cluster of short-term long positions there. Now, not every trade on the way up is going to be people entering long directional positions, but on balance, there will be more new long positions here because we traded more volume here. And when we break this area to the downside, some of these trades will unwind and help us on the move down. And that is the point at which I'm personally looking for refinement over here on the depth and sales. So I'm watching the market tick up and down. I'm looking for the ticks up to weak and short-lived. I'm looking for the market to start driving down into those stops, looking for signs of downside momentum to build. Now we can see that to an extent over here where we've got the majority red on the trade thermometer, but it is actually much easier to read watching the ticks up and ticks down on the depths and sales. So a lot of people say to me, well, Pete, what's a signal to sell on Auction Vista? Now, it's a fair question. It's nuanced. It depends on your risk tolerance. But there are 4 distinct phases. The first one is you see the depth above you. That could be resistance. It could equally be fake. What it does mean is absolutely an area of interest. We then trade into that depth, and the depth remains. It doesn't pull out of the way. The depth is real. The amount we trade in there then becomes exceptional size. So it means in this case that some new buyers are getting stuck. We've got exceptional buying, but the sellers are still taking on those orders. So like I said, these trades don't all have to be buyers initiating new trades. Some could be exit orders, some could be spread trades, but on balance, there's going to be a good enough proportion of new positions here to help us when they stop out. So seeing the size trade is another heads up. And then number 4, the market starts pushing down. That's your last signal, effectively, pushing those new speculative buyers out. And at that point, the probability of a profitable short increases, but you have lost a few ticks on the entry price in getting that confirmation. So at any point from seeing the large offers above to the buyers getting stopped out, you could have gone short, and where you go short depends on your own tolerance for risk. Now, one way to think about this, if a seller has a big position to fill, there are firms out there whose sole job is to fill big positions, and they feel that the buyers are drying up here. So they've absorbed all this buying up here. They feel there's no buyers up here. At some point, they're going to switch from passive selling to active selling and start throwing market orders in, which is why I wait for the turn, because they could be quite happy to absorb buying at higher and higher prices, but when they think the buying is drying up and start to push the market down, that's when I like to get in. Now, this slide is typical of cases where a turn in the market is defined purely by order execution and the depth isn't adding really any significant information. So we've got iceberg orders being executed, we've got something I call hidden backstops being created, and we have opposing imbalances at extremes. Now, as we can see, the market moves up to 1912, can't push through it. Yet the depth as we got up there was quite normal. Now, the volume at 1912 is exceptionally high, and the aggressors are almost entirely buying. Price can't move through 1912, but we see no sign of large size on the offer side. And that's only possible if there's one or more iceberg orders on the offer side. So as buyers buy, more contracts are added to the offers and the buyers get trapped. And what happens in the end, we end up trading 3,870 contracts into that price, 1912. So if there's no depth, but a large trade circle, that's an iceberg. Now, this sort of activity, stopping at a single price with large trading at that single price, is typical of thicker markets like the E-mini S&P 500. And it's quite rare to see this sort of thing on thinner markets like crude or DAX, where the market tends to trade high volume over a series of prices, as we'll see in a minute. Now, I also mentioned something called an opposing imbalance. Well, we're imbalanced to the buy side at the high. Okay, so that's the opposing imbalance. So buyers are active in terms of market orders, but sellers aren't. The smart sellers are adding to their offers. Now, at reversal areas, it really helps to see the market imbalance to the buy side at a high or the sell side at a low, hence the term opposing imbalance. So it's not just the circle size that's important. I mean, if you just saw a lot of size trade there, there's still a queue, but if there's an imbalance there, that really helps. Now, areas like this are things that I like to call hidden backstops. They're areas which might look completely irrelevant from a charting perspective, but they have order flow supporting the level holding. So in other words, the order flow is giving us trade entry points that might not be visible to a chart trader. And this is one of the most powerful aspects of the order flow history, giving us lines in the sand that can be both entry points and signals to exit if price crosses that line. So for instance, if you were short here at 1912 and price got to 1913 or 1912.50, 1912.75, you know your trade's in peril. You've got enough sellers absorbing contracts at there that they're going to get stopped out if it moves up through there. So it gives you a very, very good, nice tight stop and good potential to the downside. Now, of course, you don't have to enter when you see the circle. In fact, it's often better to get in when you see the market start to break down. So don't think of this as a chart with a single entry point. You can get in when you see the traders trapped, or you can get in when you see the market start to move against them. And sometimes there's as much information in what you can see as what you can't. So for example, we can't see excessive offers at the high, but we knew they were there and trying to hide because we saw excessive buying. So always think about what you see as well as what you don't. Now, I like to separate turns in the market into major and minor reversals. So a major reversal would be one that initiates a new intraday trend, the 3 or 4 major swings we seem to get in a day, on a kind of speculative day. And a minor reversal would be a simple pullback. Now, the end of trend moves are very busy. There's a lot more trading involved in reversing an intraday trend than reversing a pullback. There's more people engaged there, and it's also a spot where you find more predatory traders. Now, in this image, I've got the depth tuner set to only show the most significant depth. So that's why a lot of the depth appears to be missing here, because I've basically tuned it out. Now, we start this image on the left with consolidation, and this was consolidation after a move up. And basically we move up through the consolidation area and then back down to it. And this is our pullback, and it is a very typical pullback. And we can say a few things about the end of a pullback. It often tests the high of the prior consolidation area or high volume area. Sometimes an iceberg order will stop it as bidders step in and absorb the light selling, but a lot of the time you simply run out of momentum and sellers stop engaging. And this sort of turn is defined mostly by a lack of activity. So we don't see much. And this lack of activity is as easy to read on the depth and sales over here as it is on the chart. Sometimes you just go back to a price, a couple of times, nothing really trades, okay? Now as we move to the top, the full reversal, we can see a lot more activity. So we can see an area, absolutely, this white area here, of high liquidity above us as price moves up. We can see it's taking progressively more and more contracts to move up through prices. And this is very typical of a thinner market like crude or DAX, to see the market thicken up over a series of prices prior to reversal. And once again, we end up with a very large circle where aggressors are mostly buying, and after just another tick up, the market falls away. Now in terms of an entry, entering on that high volume circle with the backup of the depth above is absolutely a place you could enter the market, but in my opinion, it's still a risky trade. So my preference is to actually let the market break down, see some downside momentum, or even wait for a weak pullback. And again, the cost of the confirmation is you give up a few ticks on the entry price, and it just all comes down to your own appetite for risk. Now, many times the market depth is really, really irrelevant. It's not a big part of the story. And in this image, we can see just one price with significant depth, or it's definitely not the highest amount of depth. And we actually traded through that before an iceberg order held a few ticks down. And once again, we've got the opposing imbalance, aggressive sellers at a low, and we know it's an iceberg because the depth there was insignificant, yet a large amount of size traded. And for this to happen, bidders must have added contracts as we traded there. But for the rest of the time on this chart, the depth is completely insignificant. Now we can see a hidden backstop created by the trap sellers over here, and the lack of selling interest when we came back to that low. And that lack of interest, again, would easily be visible on the depth and sales as the history chart. And many times you're going to see the market eat through areas of high liquidity, and sometimes that liquidity is just one half an arbitrage strategy. So it's got no real bearing on direction. So this liquidity here could have been half of a calendar spread, okay? And over time you'll learn that liquidity alone won't stop the market, certainly not reliably enough for a full reversal. So seeing the liquidity gives you a heads up that something might occur. It's a good heads up, but it's just that. How the market reacts, where size trades, is more important than the market depth. Now, not every trade will follow through. So let's look at how we can handle scenarios where we may have gotten into a trade that then moves against us. What is it we can see that gives us a heads up? So in this case, we can see the market is coming down towards an area of high buy-side liquidity here. 30.35 is a point of control, and we can see large bids below that, which is actually quite normal. Now the market is in an overall down move, so any long trade is going to be against the overall trend. Now as price drops, we do see that depth is added to the bids, and we get to 30.35, we see exceptional selling there. We do see some of the bidders pull their orders here, but bear in mind there's a lot of participants, and there can always be a mix of spoof and real orders at any level. So don't think these high bids as all belonging to the same participant. We get this first large red circle that eats most of the liquidity at 30.35, but each time we come back to 30.35, we see exceptional size trade. Again, obviously an iceberg order there, and we can see the aggressors almost entirely selling, but price not moving down, sellers are getting stuck. We end up taking 6 attempts at selling through 30.35, and then we move up, but just 5 or 6 ticks. Now the buy side liquidity does follow that move up, but as we move back down, we can see the large bids at 30.36 get eaten, and in what a fairly rapid move down, we eat through all those bids, market collapses, okay? Now as an order flow trader, you know that at this area over here, buyers absorb the selling, okay? And those buyers are in peril if we move back down to this area. So if you'd played the reversal here and taken a long, then seeing the momentum back to your entry price should have been your cue to get out. And we can see over here, we look at the size of the trades as we get down to 36 and 37. This is crude. 68 contract trade, 160 contract trade, 36, 37. We've got some size coming in. Now this area here, if you hadn't taken the long trade, this area here is also a potential entry point, because there's plenty of short-term traders that trade momentum into stops. They are very fast trades, you're right or wrong very quickly, but that is a very common trade. Now the trade that most traders aren't looking for is up here, the weak pullback into the area where high volume trade is. So we can see high volume traded very quickly, all those bids got taken out, and then you've got a pullback into that high volume area. So buyers are holding off. We're going to see as we get up there, buyers are holding off. There's no real size. Look at, we just got one price where we've got 38 contracts. There's no real size on the way back. And again, looking for an entry here, that's one of the trades I like to take. Basically, look at where the volume traded, weak pullback into it, then take a trade. One of the easiest trades to take. So once again, we have a potential entry point here, but it's more because of lack of activity than large size trading. So my experience is the easiest trades to manage are those where you pull back to an area of higher volume and at the same time you see an extremely weak counter trend momentum. Now don't worry about learning all these things at once. As you get more experience, these things are going to come to you, but just bear in mind that lack of activity is often going to have as much meaning as lots of activity. Now, this is a bit of a busy slide, but we mentioned earlier that context matters. So let's take a step back and look at how this fits into the big picture, okay? And how we can use this information along other actionable market information, how we can use this to confirm trades and give us additional entry points that might not be on a chart. So in this market, what we've done, we're looking at a full reversal on the ES, okay? So the market's put up a 15-point move with actually decent volume. We can see volume recovered here. Now on the way up, we actually paused at 125, 2001.25 to 2002.50. We actually built a bit of volume there. And it's normal to see pausing trends like this. We've done webinars here before, day trading without charts. Market likes to move up, build volume, move up, build volume. And these volume areas should hold on a retest or the trend is in peril. Now we see some large size traded here, but we never moved against that size. So in effect, what we've done, we've traded around volume, not back through it. And from a value trader's perspective, value traders say, well, we're finding value here temporarily. On the next push up, we can see absorption at the high. So that's the opposing imbalance. Now that area is quickly broken to the downside, and that would be your highest risk, earliest entry opportunity. Now, why would you enter there? Well, first of all, the absorption at the high, okay, if we just go across here, it's the day session weekly high, okay, and it's also just before these X's, which is marking out an area of high volume from overnight. So we actually have good trade context here. So it is a potential area to short, either on the circle itself, which is high risk but good price, or just below as it breaks down, which is lower risk but poorer price. Now, as we get back down to this area of high volume, we can see a bit of large size, imbalance on the sell side, which means the bidders are absorbing contracts. And you should expect additional volume to trade. If you've used volume profile at all, you know that as you get back to an area of high volume, you tend to trade high volume again. Okay, so as we got back to there, we got a little bit of higher volume, and looking for this area to break would have been your next opportunity to enter. Now we do break down to an area of high volume, and we can see the Dow, the Nasdaq moving off their highs, the NYSE tick starting to show signs of a stock market sell-off. And next we get this weak pullback. So where are we pulling back to? We're pulling back to this area where we traded the size before. And that gives us the last selling opportunity that's visible on this screen, although more pullbacks would occur later. And what can we see here? Well, we can see weakness in the pullback, okay? We can see there's no move up in that pullback. The delta's not moving up in that pullback. The Dow and the Nasdaq and the Dow aren't moving up in that pullback. So as we pull back up here, there's no sign of strength, okay? On the tick, the Dow, the Nasdaq, or even the S&P 500. So we've got context, we've got other markets confirming, and we've got order flow all coming together to help us gauge the pressures of the downside. Let's move up. So right now would be a good time to key in any questions. So what we've seen is the Auction Vista historical order flow view, And it's more than just a pretty user interface. It gives us additional actionable information we can use in trading, and it helps us to understand when traders are getting caught offside, and gives us additional prices that become potential entry and stop out points based on areas with concentrations of positions. Now, when you read order flow, you need to think in terms of how the market's playing out over time. Don't just look for, it's not like a moving average crossover, right? Where you get a buy or a sell signal that just occurs in one particular moment of time. Okay, it's a story playing out over time. It's where are people getting stuck? Where are people going to get pushed out of position? And context is important too, as is the type of move you're trying to capitalize on. So the end of a pullback is often characterized by a lack of activity, but the end of a trend is usually characterized by a sequence of events, any of which could be your cue to enter the market depending on your tolerance for risk. Now, the market depth information is a great heads up, but trading against large depth on its own is a net losing strategy, partly because that's exactly how predatory traders try and catch you out. So, but by all means, try it on sim, fading large offers and fading large bids. The order book gives us a good heads up, but don't take it too seriously in terms of giving specific signals in its own right. Now, order flow doesn't replace good context, because context gives other speculators a reason to trade too, and you want to be getting in at when or before other traders are starting to change direction, because you won't get very far in trading if you're the only person trading in a specific direction, and that's what the context gives you. Now, the order flow does provide additional context. It does give you those hidden backstops that get created and end up being both potential entry points but absolutely exit points, because when you go past those backstops, your reason for being in that trade has effectively been wiped out. Now, the order flow events play out over time. This isn't something that occurs in splices of milliseconds. It's not even seconds. The more obvious order flow events are the iceberg orders or large bids or offers, which generate higher volume and stuck traders, and that higher volume takes time to build. The less obvious events are lack of participation. It is going to take you a little more time to learn to read that, but you have to focus on that as well. Now, algorithmic trades will, of course, be amongst all the other trades reported and all the other trades that you're seeing, but ultimately it's the sum of all trading that sets market direction. It's the time frames above you, not the ones below you, that have the most impact. Now, if buyers overwhelm sellers, the market's going to go up, and when it no longer does, the sellers get trapped, also the buyers get trapped, and the market reverses. And that's a cycle that repeats itself over and over again. As for the algorithms, well, the professional discretionary traders I talk to are actually enjoying the current market conditions, although we could probably have it this week as an exception to that. And a lot of people I talk to are saying that we're now experiencing some of the best trading conditions in many years. So I wouldn't worry too much about the algorithms. Anyway, at that, I would like to thank you for listening. And now it's probably a good time to go over any questions you have. And Eddie, are you still awake? Mm-hmm. Basically, it's the bids and offers. It's the amount of liquidity in the market. Basically, we have things like risk on and risk off, which is kind of slightly different from algos on and algos off. But basically, it's all about liquidity. If there's a lot of liquidity in the market, it means the HFTs are on. They're playing the order book. When the VIX goes up, they tend to get out of the way. So, if you look at things like when we had all that stuff about the Ukraine going on, when there's a lot of extra news risk, times like that, they'll pull out of the way. When the VIX starts to spike, the market gets really skitty, they just turn off. And you can just see it in the order book. You look at the order book one day, there's 500 contracts that are level. You go in the next day, there's 100 contracts level. Then there's a lack of liquidity. And that's the biggest impact, really, to the retail trader, is lack of activity, lack of liquidity. And that's the thing that's going to catch you out, because basically you're going to need to widen your stops. You're going to be looking at potentially having slippage on markets that you don't usually get slippage. So really, it's just the bids and offers, just the market depth. That's what I'll use. Traders should move to algorithmic. Is that? I will tell you this. I have never met a single retail trader that is making money from algorithmic trading. I know guys who I know guys who run quant firms, actually. A lot of it's spread trade. A lot of the algorithmic trading out there, everybody looks at it from their perspective. Everybody's trying to trade directionally. For some reason, they think that algorithmic trading is directional. Okay, so if you're trading spreads, if you're trading that kind of, some kind of spread, some kind of arbitrage, absolutely make it algorithmic. But I've literally never met a single directional day trader trading outright unhedged positions that does it algorithmically profitably. I've literally never met a single one. And I know thousands of traders. So I would say, I don't agree. I think it's a good time to be a discretionary trader. I do. I use volume profile. I use volume profile to see where positions are, and I've always used volume profile. And we did a webinar in here a while back called Day Trading Without Charts. Absolutely. One of the things that I do in terms of looking for reversal is basically, we move, build volume, move, build volume, and I expect us to keep moving and build volume. And then when we move back over one of those high volume areas, then I figure the market's reversed. So absolutely use the two things together. When I stop killing programmers. It should be 4 or 5 weeks. We've got one release coming out in the next few days or next week, where we're going to put the ability to trade off the charts. And then once we've got that, then we're going to put all the setting screens together. So basically, the reason it's in beta is because we're adding features and we don't have things like the setting screens for it to set the colors. So a lot of the colors are hard coded. The last thing we do before we come out of beta is to put all that stuff in there. So it works. You'll be able to trade off it next week. So it's as good as live, but we can't call it live because of the setting screens. Mm-hmm.
It should also be a type of an absorption of sell market orders. Sellers should be trapped where iceberg appears.
Mm-hmm. Yeah, absolutely. Like you say, I think an iceberg is good to enter. If the market's going up and you see an iceberg on the bid, you can take that, right? And it's one of the trades a lot of scalpers will take. One of the trades they'll teach you in prop shops. But real short-term scalpers, is that basically, when the market's moving up, as soon as you get, it's not even a pullback. You wouldn't even see it as a pullback on the chart. But just when the market's putting a momentum move, if you get an iceberg there, you just join it basically. So absolutely.
Question from Stan D saying, what are the best 4 settings based on the ES?
Okay, well, I like to have the. Okay, let's go back and look at it. Okay, so interval I like to set to 1 at the start of the day. As the day progresses, I only trade like the morning session, but as the day progresses, I just click that up so I can see more history on my chart. Interval width I set to 2, just that's why I like it. Circle tuner, if you're on crude oil, 2 or 3. If you're on the ES, 1 or 2. And the depth tuner, I like it at 1 because I think it looks pretty. But really, the settings, this isn't something where if you have one set of settings, you'll see it, and if you have a different set of settings, you won't. The interval, basically, I'll just move it up to scrunch it together a bit so I can see more information.
Next question. There's a continuation. Maybe you can add to this. 993 was asking, talking about the icebergs. Since it is an uptrend, icebergs should be backed by other buyers, and those absorb sellers should mean there's no resistance to the upside. What do you think of 993's theory?
Well, what you've got to be careful of, right, is I used to know a dearly departed friend, actually. He used to be a runner for Peter Stiedelmeier way back in the day. And I used to say to him, I say, you know, I see this must be this really dumb rich person on the ES, because, like, I see the market going up and there's an iceberg order on the sell side, 3,000 contracts trade, goes straight through it, moves up 5 or 6 ticks, another iceberg on the sell side, goes straight through it. And I'm like, what is this guy doing? I mean, why do they keep giving him money to trade? And it's like, it's what I've been telling you today, right? This is the guy that told me. He said, Pete, you've got to stop thinking about directional trading. He said, what you're most likely seeing there is 1/2 of a statistical arbitrage trade, right? He says, they're not trading direction. The reason they're putting those 3,000 contracts in, they just want to get filled. So sometimes when you see the icebergs, it's just stat arb. So they're not going to get stopped out because, you know, they're selling the futures and buying the stocks. And when they've come back together, they're going to exit the position. But they're not really. There's no sense of being trapped because they're playing the relationship and not the stock. And it's similar actually with whether on the buy side or the sell side, it could be stat arb. So, you know, my theory is if it's an iceberg on the bid side, I'll go with it because even if it's stat arb, I'm still on the right side of the market. If it's on the sell side, I mean, if you see an iceberg on the sell side and you see like 3,000 contracts trade, but then the offer comes down to like, you know, the offer's at like 1,000, then it comes down 5, 4, 3, 2, and you see the offers almost out of offers on the sell side, yeah, hit into that. Because basically, yeah, somebody has absorbed it, but as they're, you know, if they stop absorbing and the selling and the buying carries on, then that's a go with trade for sure. But generally speaking, I won't go with an iceberg on the offer side in an uptrend. But you could watch that, find that it works, and then know something I don't know about the markets. So certainly don't take it from me that you shouldn't do it.
He's got a question. When you filter large trades, you reconstruct the tape on the ES. What do you use to cut off as in the number of contracts?
50 or 100 right now. And for block trades right now, I know some people use 250. I'm still using like 500-600 for block trades.
Peter, now, I know that some were not able to hear the audio. You said you were recording this, correct?
Absolutely. Well, I've recorded it. I've just got to look at the recording to make sure it all looks okay. But it's still ticking along there, Eddie. So yeah, there will be recording. It'll probably be up in a couple of hours, actually. Yeah, I'll put the YouTube channel up as well. Oh, jeez. See, I'm not always prepared, Eddie. All right. There's yeah, it'll be on this YouTube channel. There you go. It's posted in the room. Give me a couple of hours, depending on how my PC churns through the video. Should be up there. It was 5 million. Unfortunately, it doesn't still stand. The guy who made the offer, his situation has changed. So he's not at that firm anymore, basically. It was the firm's offer.
Mark's got a question here.
Most excellent. That's a Bill and Ted term, isn't it? It's most excellent, yeah. Yeah.
I got a question from rookie here, and then we'll call it. What's the best way to work out the best parameters for divergence, iceberg, and large quantity alerts on the subroutine? I guess they differ from market to market.
They do basically. Honestly, the easiest way to do it is you set low numbers, and if you get too many alerts, put them up. I know it sounds stupid. It sounds like curve fitting, but at the end of the day, you are looking for the outliers. So like a divergence alert. A divergence alert is basically when we trade more on the buy side, but the market ticks down. On the S&P 500, you're looking at 1500 before really that's of any significance. If you do it when there's 20 contracts traded, it doesn't make a lot of sense. You want to see some size, and you want to see it kind of get rejected. So it sounds a bit like curve fitting when I say that, but like it's the easiest way to do it. Just like try small numbers and put them up when you get too many signals.
Last comment here, Batman saying, digging the heat map.
Thank you, digging. That's back from the 70s, that isn't it? Digging.
But Peter, I'd like to say thank you very much for being with us here. Once again, Peter's website, www.jigsawtrading.com. Peter's on with us every Tuesday and Thursday around 9:35 Central Time, and each and every day sharing this blog with us, the pre-market prep with ES, here early and
Oh.
get that blog. But otherwise, Peter, I know it's probably 5 o'clock in the morning.
It's 1:20.
Well, your clock goes backwards on the.
Yep.
Let's stay on. Anyway, Peter, get some sleep. We appreciate you being with us here. And once again, there's the link, www.jigsawtrading.com. And if you can, join us during the week, Tuesdays and Thursdays. Peter,
Thank you, Eddie, and thanks all for popping in.
any closing comments here? Any reflections?
Yeah, just go to the website. There's a try buy link. If you get the way we do it, basically, if you buy the tools, you don't like them for any reason, just ask for your money back. You don't have to tell us why. You don't have to, jump through hoops. Order flow is not for everybody, so we like people to give the tools a try. And if they find order flow is not for them, that's fine with us. Absolutely. All right. See you. Have a good weekend, everybody. Bye.